My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Let people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Good news today? Turned out to be, well, good news. When the Labor Department's non-farm payroll report showed a huge job gain in September, far more than expected, causing interest rates to rise dramatically. And yet the stock averages roared anyway. Buy! That's right. Even though interest rates shot up dramatically in response to the incredible job growth, the averages shocked us. With the Dow gaining 341 points, the S&P climbing 0.90%, and the Nasdaq jumping 1.22%. For years, we've been taught that when bond yields go up, stocks go down. But today was the exception to the rule. Ever since the Fed gave us that double rate cut last month, well, we've been afraid that they acted so decisively because something might have been wrong with the economy, something they knew about, but we didn't. So when we got these robust employment numbers, 254,000 new jobs, Wall Street was only looking for 150,000. And we got a revision upward from the previous 2 months, 72,000 additional jobs July and August. I figured stocks would just get hammered as bond yields soared. After all, if the labor market's strong, there's no need for the Fed to keep cutting aggressively, is there? But in a highly unusual move, the losses were contained to housing, the one sector that's totally hostage to the bond market, particularly longer rates, because that's what sets mortgage rates. People breathed a collective sigh of relief that we weren't headed for a crash landing, and they bought stocks with both hands. Maybe we aren't headed toward a landing at all, and maybe that's why the usual stock sell-off when rates go higher did not occur. It was quite anomalous and, frankly, quite exciting. The leaders, in another twist, the bank stocks shined, Historically, they perform poorly when rates zoom. However, right now we're more concerned with credit losses and defaults. A strong job market means fewer bad loans. Plus, big money center banks like J.P. Morgan and Wells Fargo, well, they benefit enormously from anything that bolsters the net interest income. If the Fed slows down its rate cuts, they make more money. Those two stocks have a lot more to run if today's an indication of what could occur. Tech also tends to do poorly when bond yields soar, but the group rallied like crazy today. Leaders, Meta up $13.17, or 2.26%, and Amazon, which have been going down, up $4.55, or 2.5%. These are astounding figures for a day when interest rates just soared. So was today's action a one-day wonder, or will the market revert to the historical norm? We're going to find out next week, which brings me to our game plan. Until today, bond yields were going down as part of what is known as a flight to safety trade. When war breaks out in the Middle East, people around the world buy U.S. Treasuries for safety. At the same time, oil had its best week since early last year, even if oil only rallied 1% today. People are worried that a wider war might lead Israel to bomb Iran's oil facilities, and Iran produces 4 million barrels per day. If that happens, crude could be headed to the 80s. I have no special insight here, but we'll probably see an Israeli counterattack maybe as early as this weekend. Who knows what would happen when we come in on Monday, but I just want to prep you. Tuesday marks the beginning of earnings season, when PepsiCo reports before the open. Now, this reliable food and beverage stock has been hit with multiple price target cuts, okay? But maybe that's put a lid on expectations to the point where the stock can stabilize on somewhat inline results. By the way, it doesn't hurt that PepsiCo sports a 3.2% yield, which is pretty darn good, especially as long as Treasury yields stop going higher. It sure is tempting. Hey, you know what tempting is? General Motors. They hold an analyst meeting Tuesday. Jim's having a great year. Stock's up 27%. I think the redoubtable CEO, Mary Barr, will tell a strong story about how the company's been able to put up quality numbers even when interest rates were higher. So who knows how well it can do now that the Fed's our friend. Holy cow. Hey, by the way, unlike Ford, GM has a substantial buyback, which has clearly helped its stock. By contrast, Ford stock's down 13% for the year. Given that GM still trades at less than 5 times earnings, and as long as Barr doesn't cut the forecast, I think the stock can only go higher. Wednesday, we get the Federal Open Market Committee meeting minutes from last month, which should shed some more light on their decision to bless us with that double rate cut. Everyone keeps trying to guess whether the next cut will be 25 or 50 basis points. After today's robust employment number, you know what? I think it's going to be 25 or nothing. Then again, what really matters is the overall direction for rates. And that direction is most definitely lower, which is bullish for stocks. Thursday's practically overflowing with, what a day. This is an incredible day. First, there's the consumer price index that comes out at 8:30. If you want the Fed to cut at the next meeting, we need to see a cool inflation number, don't we? Let me get results from Delta. The airlines came on strong today with huge insider buying at Southwest Air after that reorg. I'm not a buyer of the airlines. They're too fickle for me. But I bet Delta tells a good story. We're going to hear from Domino's, formerly Domino's Pizza, before they open. And the last quarter was a big disappointment, largely to surprisingly weak numbers from overseas. We had doing analysts today saying positive and negative things. You know what? That does make Domino's stock a little hard to call. But if push comes to shove, I go with the buyers, not the sellers. Then we have one of the most exciting things ever. Well, actually, we have three different events. I don't want to get the story. I don't get the cart before the horse, but we have one of the most exciting meetings ever, and that's going to be Elon Musk's We Robot event, okay? This is for strategy for autonomous driving. I think this meeting will show off Tesla's technological edge and will be incredibly well received. And you won't think of it as a car company after this meeting. You'll think of it as a tech company. And that's why I think you should buy the stock ahead, okay? Ahead of this meeting. Not to be outdone, Lisa Su, the CEO of AMD, will hold an analyst day, and it's entitled Advancing AI 2024. It starts at noon. Today, when the stock was plummeting, I told Investing Club members at my 10:20 morning meeting that Sue's presentation could show this charitable trust holding in a whole new light, even as they've been raising their AI sales forecast quarter after quarter after quarter. I think it's a buy ahead of the meeting, although the stock did run 8 points after we talked about it at the morning meeting. And finally, we will hear from HP Enterprise. This is a company holding an analyst day dedicated to its AI efforts, which are substantial and underestimated. I think it, too, will be a needle mover. If I'm right, we're going to go 3 for 3. You got to be long these stocks. I think it's going to be good. Friday, we get another just overload. We get the PPI index at 8:30, maybe a more rate cut guessing game. Don't lose sight of the fact that as long as we're in a rate cycle cut, you don't need to worry about every single piece of data. Once the Fed starts cutting, you need to worry a lot less about what stocks will do, period, because the Fed's got your back. It's a mistake to tear your hair out trying to guess Jay Powell's next move. All I can do is report what the numbers are and tell you to focus on earnings, not rates, and that's how the money will be made. On Friday, we do have an onslaught of financial earnings in the morning. We've got Wells Fargo, JP Morgan, and BlackRock. I think the banks represent the least expensive group in the market, which means you need to use any weakness to buy them. BlackRock, Larry Fink's done an incredible job, not only in making money, but also producing the best asset management software. I don't think his company gets nearly enough credit for either. And its stock deserves to trade higher. I think it could break out here. Oh, and one other thing. Real excitement. NVIDIA's Jensen Huang will be ringing the NASDAQ opening bell with his team to celebrate the birth of the GPU 25 years ago. Those are the faster chips that make generative AI work. Congratulations to the NVIDIA team. Here's the bottom line. A market that appreciates good news like a robust job creation number is a market that can handle, well, let's just say, the historically tough month of October. After today's performance, all I can say is, so far, so good. Michael in New York. Michael.
Hi, Jim. This is Michael. My wife and Gail and I are longtime club members, second-time callers. We watch your show every evening. We trade based on a lot of things we hear. We've made plenty of money with you. So
man, you are a gent. Thank you. It's been a tough week because of my voice, so I really appreciate hearing that. Really nice. Thank you. How can I help?
Thanks. Jim, I remember flying over 3 Mile Island more than 40 years ago in 1979 and watching the smoke and steam blowing across the sky. Since then, nuclear energy has been in the doghouse.
Yes.
However, the technology required for safe operation of nuclear plants has improved dramatically. At the same time, our need for clean energy has increased enormously. Maybe now's the time to let the dogs out. The company I'm calling about has recently entered into an agreement with Microsoft to reopen one of the 3 Mile Island reactors to provide clean energy to Microsoft to operate its data centers and cloud computing operations. The stock is up more than 50% in less than a month. Is it too late to buy Constellation Energy? Or would you recommend a different stock?
No, every time I say it's too late, I mean, this one we've been behind this one. It's moved up greatly. GE Vernova, we've liked that's moved up greatly. But there is more room to run if you're right, and I think you're going to be right. So I don't think it's too late. We are in a parabolic portion of this move, and I don't like to buy it at its 52-week high, like a little bit of a pullback, but I think the idea is a solid one. Let's go to William in Michigan. William.
Hi, Jim. How are you?
I am good. How about you, William?
Doing well, thank you. During Q2, I bought Wynn in the mid-90s. It dropped all the way to the low 70s, and I rode it all the way back up thanks to the China stimulus. It's up more than 30% in the past month. Should I continue to hold?
I think, look, I'm actually the wrong person on this because we decided to consolidate to our Chinese names and get out of Wynn, and then it had a big run. I talk about my winners. I talk about when I didn't do it right. I underestimated this Chinese stimulus play. I said you could do it only with BABA. I think its stock can go up a little bit higher, but it is selling at its historic PE multiple, so let's be a little careful. All right, the market is reacting favorably to good news, which means it has the potential to handle the typically tough month of October, doesn't it? On Mad Money tonight, the maker of Modelo and Corona fell on a mixed report. So what's brewing this latest action? I'm thinking through potential tariffs, beer market share, and more with the Constellation Brands top brass. Then should we be looking in the rearview mirror to get a sense of the road ahead for the market? I'm turning to the Treasuries after the Fed's latest cut and today's labor report. And with Halloween on the horizon, I'm checking in with private player Smarties to see what this legacy candy company has in store. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
All right, what the heck happened yesterday to the stock of Constellation Brands? The maker of beer, wine, and liquor, best known for its top-notch portfolio of Mexican beers, think Corona, my favorite, Pacifico, and the best-selling beer in America, Modelo Especial. They actually reported a mixed quarter, and yet the stock dropped nearly 5% in response. While Constellation sales came in a little weaker than expected, the company still delivered a 24-cent earnings beat off a $4.08 basis, thanks to some cost-saving initiatives with much better than expected cash flows as well. They're still taking lots of market share in beer, and even their struggling wine and spirits division saw some green shoots. But is that enough? I think you may be getting a buying opportunity for a stock which, in full disclosure, I own from the Chapel Trust. But don't take it from me. Let's dig deeper in person, with Bill Newlands, the president and CEO of Constellation Brands, to find out more about the quarter. Bill, welcome back to Mad Money.
Thanks. Good to be here.
Bill, your stock's a complicated one because it'll come out and some look good and some numbers look bad. The stock pops up 3, then goes down. But in the end, this is just, to me, another consistent Constellation quarter of market share take, cash generation, and now bigger buyback.
All of that's true. We gained 1.3 share points in our beer business this quarter. We had our second biggest operating margin in the history of the company. We bought $250 million worth of share buybacks in the quarter. We got a lot to be excited about.
Now, in terms of what the people are most concerned about, I think there's people who just think, you know what, we're going to put a big tariff on beer. One person wins as president, and that somehow is going to hurt your sales. How do you deal with the tariff?
I think a couple of things to keep in mind. First of all, assuming there was a Trump administration, we already had 4 years of a Trump administration, and our business was up double-digit during that window of time. 1. 2, we have a fair amount of our inputs that come from the United States and then are made into beer in Mexico. I highly doubt any perspective on tariffs would really be around how do you hurt the American farmer. That seems illogical in the scope of things.
And at the same time, we don't really want Mexican beer from, say, Flint, Michigan.
Well, that won't happen.
All right.
These are authentic Mexican beers. Guess what? You have to make them in Mexico.
That's true. Now, you recently had one of the first, I think, meeting with the president-elect of Mexico, Claudia Sheinbaum. What was that like?
It was terrific. I think she's very focused on making sure there's shared prosperity. And, we have several thousand employees now in Mexico, and we're continuing to invest in the business in that marketplace with our newest brewery coming online soon in Veracruz. So very, very good relationship with the government of Mexico at all levels, at federal, state, and local.
Right now, you mentioned the new brewery. I have been concerned that that's cost you a lot of money. But if we could ever get to the peak of the spend for that new brewery, then you're going to start to see cash really build. Are we close?
We are close. This fiscal year is going to be our peak in terms of capital going into the ground in Mexico. So you will continue to see, and I know you saw this, we hit our leverage ratio this past quarter as well. So I think it opens up a lot of windows for us to do a lot of things with our share buyback.
Well, let's talk about a window. When does the window open for you to be able to buy back stock? And will you do that at these levels?
As you know, we have $2.2 billion in authorization still from our board to be able to buy back shares. We were very opportunistic both in the first quarter and the second quarter. And given we have hit our leverage ratio, I think you'll continue to see that approach.
Okay, I also want to see more, a big push. I would love to see more marketing because you've got these beers. And when you have winning hand in liquor, I know how hard the liquor business is. You got to put your money behind what's working. What will you guys do in the second half, in the next upcoming months for advertising and marketing?
One of the best things that happened in this quarter is our ability to be cost efficient and operationally efficient has been way ahead of what we thought it would be. And we're going to double down in the back half of the year and invest more against Corona, Modelo Cheladas. You've probably seen in football, we've been on all the NFL games. We've been on college football. We're doubling down at a time when a lot of companies who don't have growth and don't have our cash flow simply can't.
Okay, so walk me through this. A lot of people feel, and the analysts are all they have some trepidation, that the numbers, the beer growth is, because there is growth, the beer growth is slowing. But if you put money behind these top beers, that doesn't mean that it's going to continue to slow.
That's true. In fact, if you look at the most recent weeks in Circana data, the 4-week was better than the 12-week and the 26-week. So you're starting to see some of this come around, and it happens to correlate directly when we started to put more money into the system.
Well, there you go. That's what I want to hear. Now, let's talk about Pacifico, because you know that has been something that I've told you over and over again. When I see that level of growth, I want to see more money behind it. Where are we? Who's drinking it? What does it mean?
It's a little younger consumer than the overall portfolio. It happens to be the number 2 beer in Los Angeles. I mean, think about that. It's the number 1 beer market in the country. Pacifico's number 2 in that market. It was up 23% in the quarter. That's a brand, I always describe it as a mini Modelo, meaning it's kind of where Modelo was 10 years ago in terms of its growth profile.
Okay, now I also want to talk about wine and spirits. It's been such a drag. And, you know, you and I have gone back and forth. You've always been very forthcoming. Not happening. This time, though, you said some green shoots for the premium ones, which is what I care about, because the gross margin's so good.
Correct.
What are we really seeing that we can hang our hat on?
Beginning of the year, I said it's going to take us 9 to 12 months to get things sorted out. We're 6 months into that. The thing that's good is we have readjusted a lot of our marketing spend. We've done more tactical spend against some of those critical brands like The Prisoner and Kim Crawford and Meiomi. And it's starting to show some success. We've seen those businesses start to turn. The challenge continues to be at the very low end. But certainly the business up the price ladder, much like we do in beer, where we're only in the higher end of the business, is starting to perform much better. All
right, one last question. You mentioned several times in the call about employment. If unemployment grows, it could be difficult. We got a barn burner employment number today. Is that the kind of thing that makes you feel a little better?
It sure does. You know, given that half of our consumption base in beer is the Hispanic consumer, and that unemployment rate having slightly higher, to see a jobs report like we saw this morning gives us a lot of excitement. It means more people are going to have more money in their pockets, and that's good for the beer business.
Excellent. It sure is. The cash flow here is immense. It's why we've been sticking by for many years now. That's Bill Newlands, President and CEO of Constellation Brands. Mad Money's back after the break.
Coming up, something big is afoot in the game of treasuries. Cramer goes off the charts to make sense of the action. Next.
Did the Federal Reserve get ahead of itself with that monster half-point rate cut last month? That's what a lot of investors are wondering after this morning's incredibly strong labor report. Certainly, it's hard to imagine the Fed continuing to slash rates aggressively after it created more than 250,000 jobs last month, with average hourly earnings up 4% year over year. I don't want to bemoan wage growth. These wage gains are finally outpacing the rate of inflation, which means consumers can get some much-needed relief. But If you were betting on a series of rapid-fire rate cuts from the Fed, maybe another 50 basis points at the next meeting in early November, then today's labor report seems to make that a lot less likely, doesn't it? Here's the thing, though. When you look at the bond market, that's not what most money managers were betting on. In fact, institutional money managers have been shorting what's known as the 10-year Treasury futures contract, and they're shorting like crazy. They're betting on lower bond prices, which means higher long-term interest rates, okay? Lower prices, higher rates. That's a stark contrast to the action in the stock market, where everything that could benefit from lower rates has been flying ever since we got word that a 50 basis point cut was on the table last month. So clearly, something big is happening in the world of treasuries. And to understand what it means, we got to go off the charts with the person who brought this to our attention, Carly Garner. She's a terrific technician who's the co-founder of DeCarly Trading and the author of Higher Probability Commodity Trading, because she sees something major going on beneath the surface. And I got to tell you, when I read this, I said, we have to have it on tonight. Yeah, but things take an ugly turn in the coming months. You can't say you weren't warned, because when Garner's looking at the bond market, that's exactly what she sees. Last Friday, the Commodity Futures Trading Commission released its weekly Commitment of Traders report, which shows you how all sorts of investors are positioned in the futures market. And right now, large speculators and leveraged funds have an unfathomably large net short position in the 10-year Treasury futures. Not only is this the largest bearish position ever held by these two categories of market participants, but it also dwarfs most previous instances. That's right. These two groups of money managers are the most bearish they've ever been on the price of the 10-year. Remember, prices go down, rates go up. Again, when you're betting that bond prices will fall, it means that you think that interest rates are going to soar. So they see long-term interest rates going up, 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 which is not what normally happens at this point in the business cycle. Typically, when the Fed starts cutting, bond yields go down, down, down. Now, Garner can't tell us precisely why so many money managers are making this bet, but maybe history can. The last time the Fed embarked on a rate-cutting campaign was in mid-2019, although Jay Powell signaled it was coming after he tightened too aggressively in 2018. This cutting cycle went from gradual in late 2019 to very extreme once the pandemic hit, and the Fed needed to rapidly cut rates to zero in order to keep the economy on life support. But if you look back at the first rate cut, it's roughly analogous to where we are right now. Back then, the 10-year note futures bottomed in October of 2018, okay? Several months before the Fed started cutting. That was the peak of the Fed's hawkishness. Jay Powell was still talking about multiple additional rate hikes and how he needed to destroy the economy in order to save it from nascent inflation. Maybe not his best moment. Now, at the bottom for the 10-year Treasury in 2018, large speculators held a net short position of about 680,000 contracts. At that time, that was a record extreme. As of last week, though, large speculators were net short by over 1 million contracts. 1 million. As for leverage traders, the net short position is double the size of what it was 6 years ago. The difference? The Fed was still tightening in October of 2018, so they weren't fighting the Fed back then. The final rate hike of that cycle came in December. This time, the Fed's already cutting rates, and these money managers are still betting on higher bond yields? As Garner sees it, they're not just fighting the Fed. They're actually spitting in Jay Powell's face. Maybe they expect another wave of inflation with rates coming down. Maybe they're worried about the bloated budget deficit and a ton of bond issuance to pay for it, or maybe a little both. Either way, Garner points out their wagers are enormous. And whether they're right or wrong, once they unwind this trade, it's going to create a tremendous amount of volatility. If they're right, though, we'll get wildly higher interest rates. That'll be devastating to both the economy and, yes, to our stocks. However, when you see everyone leaning one way, in this case, a bet that bond prices will plummet and rates are going to soar, the crowd tends to be wrong. Now, Garner points all this out. Ever since the turn of the millennium, federal funds rate, the one set by the Fed, has been absurdly low by historical standards. First, there was the dot-com crash, followed by September 11, which forced the Fed to keep rates under 2% for years. Then, every time the Fed tried to normalize rates, taking them higher, something got in the way. First, the financial crisis, followed by the Great Recession, then the pandemic. Just look at the trajectory of the Fed funds rate going back decades. Now, if you lived through the 70s and 80s, like me, you know that even when the Fed cut aggressively back then, that just meant taking short rates to 4 or maybe 6%. That was the lowest rates got back then. Meanwhile, even at the peak of the latest tightening cycle, the Fed funds rate only hit 5.25 to 5.50, although, of course, we felt it pretty hard. Why is this? Because we live in a completely different world now. Garner points out that the Fed no longer needs to work as hard to stamp out inflation. Instead, we've got plentiful domestic oil production, more efficient farms and ranches, lots of automation, tons of cheap manufactured goods from overseas. Remember, other than 2022 and 2023, we haven't had any truly serious inflation since the 80s. And now that the rate of inflation is getting very close to the Fed's 2% target, Garner expects the Fed will take rates much lower again. We might not see zero like we did during the pandemic or the aftermath of the financial crisis, but she wouldn't be surprised if we see 1 to 2%. If she's right, then all these money managers who are shorting the 10-year right now, they're in for a rude awakening. They're going to get their heads handed to them. Finally, check out the monthly chart of the 10-year Treasury note futures. Bizarrely, Garner says this looks like a lot like 2007, even though the current moment has very little in common with the run-up to the financial crisis. Still, Garner points out that the 10-year is coming off a double bottom near 105 right here. Okay, very important, bubble bottom, because it always seems to work. We're now seeing a pause in the rally, very similar to the double bottom in the 10-year we got in September, October 2007, about a year before everything fell apart. According to Garner, if the 10-year repeats its trajectory, it could soar to 122, which would be the yield of the 10-year about 2.25 to 2.5. Amazing. So here's the bottom line. The charts, as interpreted by Carly Garner, suggest there's a legion of money managers who are trying to fight the Fed by betting against the 10-year. That's usually any guy, they're making a huge mistake, and you and I will do well with our stocks. Maybe they know something we don't. But even if that's the case, you're taking your life in your hands when you're fighting the Fed. I always say that. Let's go to Alan in Illinois. Alan.
Hello, Jim. Great Friday evening. Booyah to ya.
Oh, thank you, Alan. Thank you for calling. How can I help?
First thing, I want to wish my dad, Harold, a happy 88th birthday today, and thank you and your staff for all you do for us home gamers.
We are dedicated to you. We are dedicated to you. That's what this show is about. That's why we're still on.
That, sir.
Thank you. Thank you.
The stock I'm interested in, man, is LRCW, Lam Research. What do you think?
LRCX. Okay, I think this stock is down way too much. I think that there's going to be a renaissance of the semiconductor capital equipment stocks, and that this thing is just ripe to buy. What a great company. And you should be buying it right here, right now, on happy birthday to Harold. Happy birthday to Harold. Let's go to Cliff in Georgia. Cliff.
Booyah, Jim.
Booyah, Cliff.
All right, Procter & Gamble. Buy, sell, hold.
All right, so we're down to tag ends now, Procter & Gamble for the Charitable Trust. And we did say in our last meeting, I was telling this with Jeff Marks, we feel like that we want to hold on to a little bit just because it is such a great company, but it's not the right stock to buy right now when you're talking about the Fed cutting rates. Historically, it has underperformed during this period, so let's be careful and don't be big in it. Let's go to Sumit in Washington. Sumit.
Hi, Jim. Booyah. Thank you for everything that you do. We love you.
Thank you. Thank you very much.
I have a stock that I think has really good growth and a steady dividend. Recently has upgraded by JP Morgan and Wells Fargo in $185 to $200 area.
Okay.
Down recently, upcoming earnings, and potentially it's going to resolve its TELC lawsuit settlement that's coming up. So my stock is Johnson & Johnson, wondering if it's got good growth.
It's very rare that I've ever seen the stock at a below market multiple like it is now. I can't imagine that you can get hurt very badly buying J&J. But again, when the Fed's cutting, you tend to want to stay away from the drug stocks and the food stocks and go in a little more something that I would say that has more cyclicality. But J&J at 160, that's fine with me. Right, the charts interpreted by Carly Garner point to a horde of money managers that are fighting the Fed by betting against the 10-year. If history's anything guide for us, it looks like I think we're making a big mistake. Now, much more mad money ahead, including my look at a family-run, privately held candy company, Smarties. Then could a possible Spirit Airlines bankruptcy have been avoided if the JetBlue merger went through? I'm giving you my latest on antitrust and the FTC. Of course, all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer. On Wednesday, while you were worried about the war in the Middle East or the vice presidential debate or the fallout from Nike's disastrous earnings report, you could have been taking it easy and celebrating National Smarties Day. For some of us, every day is National Smarties Day. This is my number one favorite candy. I've been addicted to these things ever since I was a kid. I talk about them constantly at the office. That said, I never really appreciated the story of the 75-year-old Smarties candy company until now. A company based not too far from me and not too far from here in Union, New Jersey. This is a privately held, family-run company. Means you can't buy stock in it, sorry. But as we get closer to Halloween, I think this is the perfect time to dig deeper into the business of candy. So let's take a closer look with Liz D. She's co-president of Smarties Candy Company. To learn more, Ms. D, welcome to Mad Money.
Thank you so much. I am so happy to be here and to be talking about Smarties with you today.
Well, I know they are the star of the show, and I have to tell you, one of the reasons why I like them, I'm just get it, full disclosure, the calorie count. It's just better than any other candy that I eat.
Yes, at only 25 calories a roll, a lot of people like that, appreciate it. And, I do hear that pretty regularly, and I like that too, actually.
But now another thing that people are worried about, I know there's a lot of talk that maybe things have gone up too much in price. You go to the supermarket, it seems very expensive. I want to know about candyflation and Halloween.
Yes. So, first of all, the U.S. candy market, let's just talk about that for a second, is an over $48 billion market in 2023, and it is growing. Now, non-chocolate is growing disproportionately faster than chocolate, in part because of these rising cocoa prices that we've seen this year, hitting record highs that we haven't seen since the 1970s. Now, cocoa purchases are going up, but not at the rate that we're seeing non-chocolate candy like Smarties or Chewy candy.
So you're talking about a bargain versus chocolate.
Yes, relatively speaking, Smarties in particular does offer a lot of value on shelf. We've been known for that for the last 75 years, actually, originally being known as a penny candy, and of course costing a little bit more than that now, but still, especially on Halloween, when people are purchasing huge quantities of candy, they are going for value. And if the top two drivers for candy purchases we are seeing are price and brand loyalty, and Smarties delivers on both.
Now, you've got both sides. You've got one with fewer and one with large. What's the difference in terms of cost?
That's right. Well, it kind of depends where you're shopping, but we do have the minis. We have the original size, which is the ones you're talking about. They're 25 calories a roll.
You haven't taken any out of that, right? It's not like three less or anything.
No.
Shrinkflation.
No, we're not seeing that here. And then this is our largest Smarties roll, which of course does have a higher ring. And this is our mega roll. And a lot of people do choose Smarties because of the value, as we discussed before. And we do our very best to keep delivering value to the consumer, competing with the much larger candy giants. And we're able to do so by, frankly, investing in our processes, investing in our team. And we still are able to manufacture right here in New Jersey and in North America and Canada. So we produce over 75,000 pounds of candy per day. Per day, yes, and we produce 5 days a week, and we begin producing for Halloween in the spring. Now, this year in particular, we are seeing Summerween. So you probably noticed this on retailers' shelves, Halloween sets beginning earlier and earlier. We had customers asking us to ship right after Memorial Day. Now, that is looking good for Smarties for Halloween because Halloween represents over 25% of our annual sales. So it's very important to us that people do continue to choose us for Halloween. And part of why they do is the 25 calorie roll. And another part is, of course, the value, the brand loyalty, and being top allergen free.
Okay, all those things have got to be equally attractive both to the consumer and to your competitors. Why have you not sold out to one of the candy giants?
So honestly, we do get reached out to almost every day. And I can say, again, Smarties is not for sale. It's important to us to maintain our family legacy. And we love what we do. We love our team. We love manufacturing right there in New Jersey, which is where our company was founded. I'm a 5th generation candy maker, and that's important to me. So I'm very proud to still be family owned and a woman run business as well.
Now, what is your suggestion for how people should do this? The reason I point out is that I always put a bowl out, and I tell the little kids that they can have as much as they want. Do you think some people go like that, or some people using the big ones? What's the strategy of Halloween for you?
Well, I am all about being generous with candy. Of course, we give actually every team member about 30 pounds of candy per year to share on Halloween, which makes them very popular around Halloween. I like allowing people to have as much candy as they want. And when we're thinking about Halloween in particular and today's consumer, over 20 million Americans have food allergies and 1 in 13 kids. So being top allergen free is really important and something to consider whether somebody chooses Smarties because it's top allergen-free or something else, you don't know what the needs are of the trick-or-treaters coming to your door.
Because they just really taste good. And each one actually does have a flavor, doesn't it?
Yes. Every color represents a different flavor. There are two that stump people pretty regularly. It's the green. I don't know. I don't want to put you on the spot, but the green is strawberry flavored. Fooled
me. Absolutely. Now, what do you think a percentage of households eat candy? What's the number?
We are seeing over 98% of households do purchase candy, although inflation has affected their candy purchases. Right. Many of them choosing to buy products based on things they already know and love, nostalgia being a huge driving factor for candy sales.
98%. I'd like to be in that business myself. I don't blame people for trying to buy your company. Liz D, co-president of Smarties Candy Company from Union, New Jersey.
Yes, Union,
about
New
10
Jersey.
miles from where I am. Everybody's back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Christian, it's take back for calls. You say not considered by. So I don't know the calls, but head of my staff prepares the graphics to land on the sound. And then the lightning round is over. Are you ready, Ski Daddy? Come to the lightning round, Kramer. So let's go to Chris in Virginia. Chris.
Booyah, Mr. Kramer. This is Chris from Virginia. How are you today?
I am doing fine. How are you, Chris?
Oh, I'm fantastic. It was a great day in the market.
Go
ahead.
No, you're
I'm calling about a company. I'm calling about a company that in part repairs and sells aircraft engines at healthy margins in that segment. The stock has been on a real tear the past year, and I'd like to understand if it has more room to run in the long term. The stock that I'm calling about is ticker symbol FTAI. Thank you.
That stock is too hot for me. I would prefer to be in RTX. I think it's a better buy. I understand this is momentum stock. I'm not going to say people don't play it, but it's too expensive for me. I want to go to Tim in Florida. Tim.
Hi, Jim. Good to talk to you. In light of all the recent catastrophic events and seeing how important cell phones are in connectivity, what do you think about ASTS? It's a cell phone satellite company that's in a great position to tackle this problem, to give people everyday smartphones, good connection all over.
And this is ASTS. I got to tell you, I talked about this today with Ben Stoto, our chief scientist and research director. And I've got to tell you, to me, it's just too hot. I know that's two stocks in a row that I've said are too hot, but I have to be mindful of stocks that are just up straight. I get worried about them. Let's go to John in Texas. John.
Hey, Jim. How you doing?
I'm doing fine, John.
My wife uses Shopify for her Mahjong business, and she's loved Shopify. And I've been an investor for several years, but we've been in the wilderness for 3 or 4 years. Are you still long-term feeling pretty good about its prospects?
I'm feeling about both. My wife loves Mahjong. It's incredible. And yes, I think that Shopify is at a great level to buy. I think that Harvey Finkelstein is doing a terrific job, and the stock should be purchased here. Let's go to, I'm going to mispronounce, I'm sorry, Eugenie in New York. Eugenie?
Eugenie, but that's fine.
I tried. Thank you.
Yeah. I wanted to ask about Kaspi, KSPI.
Okay, so you're talking about, all right, this is fintech. It's a good company. I prefer. Right now, I've been watching PayPal. I think it's a similar business, and I think a better value. We're taking more. We're going to Michael in Virginia. Michael.
Hey, booyah, Kramer. How's it going, buddy?
I am doing well, partner. How are you?
I'm doing great. Hey, thanks for taking my call. Hey, I wanted to get your thoughts on First Watch Restaurant Group.
Right now, this restaurant group is very weird. It favors scale and not small, so I get Restaurant Business News, and I got to tell you, I'm worried about First Watch as being a competitive outfit because the multiple's way too high, so I'm going to say no to that one. Let's go to John in New Jersey. John.
Jimbo, a big booyah!
Wow, I like your fired-up approach to life. What's happening?
Jimbo, thank you for everything you do. Your energy's electric and it's nonstop. I love it. Listen, I'm calling about a stock right now. They're buying back their stock. There is no debt, okay? They provided uniforms for our medical staff in Paris. Shout out to all our medical and hospital workers. In Q4 of last year, Ron Barron discussed in his shareholder letter that Harvard Business School was going to be doing a review on this company in 2024. The review just came out. It's called Scrubbing the Status Quo. Jimbo, this stock is electric. You ask anybody on the street, Figs, do you like the scrub? They say yes. They love it.
Look, I think Figs is not expensive and a very good spec. That's all I can say about it, though. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, feeling blue from a lack of spirit? A conundrum at 30,000 feet. Next.
This morning, we woke up to a very discouraging story about how Spirit Airlines, the low-cost airline, is exploring a bankruptcy filing. According to the Wall Street Journal, Spirit's negotiating with its bondholders about some sort of restructuring that will allow it to stay in business after it failed to merge with JetBlue. The airline shares have been crushed from $16 and change in January to $1.69, including a nearly 25% beatdown today. And the company hasn't made an annual profit this decade, so this all may be just a bit of a foregone conclusion. However, it didn't have to be this way. Not that long ago, Spirit was trying to combine with competitor JetBlue in a $3.8 billion merger, but the Justice Department sued to block the deal, and a federal judge backed them earlier this year. So in March, both companies walked away. Now, I've been a vocal critic of the Justice Department's antitrust division, along with the FTC, the other big antitrust regulator. I think they've got an itchy trigger finger when it comes to gunning down mergers and acquisitions. But it is undeniable that our government was way too lax, allowing so many mergers in the airline business over the past 20 years, to the point where we only have three major airlines, United, Delta, and American. We've lost Continental, Northwest, U.S. Airways, something that definitely decreased competition and then increased prices for you. Air travel was so much cheaper 15 years ago. Kids have no idea these days. So when JetBlue and Spirit, two budget airlines that compete heavily for customers, sought to join forces, it made perfect sense to block the deal. As someone who flies quite a bit, I was always surprised at how little it costs to fly from, say, New York to West Palm or Fort Lauderdale. I attribute that to the wonder of competition between JetBlue and Spirit. Today, though, we see the downside of antitrust regulation. Even though Justice had every right to block this deal, Spirit's in such bad shape they were basically losing a competitor regardless. Suppose Spirit does a reorganization that eliminates their most competitive routes, like the New York City to East Coast of Florida routes. That's going to be tough for consumers. We might have been better off letting JetBlue buy the darn thing. Now, we saw something similar happen back in 2015 when drugstore giant Walgreens tried to buy Rite Aid, $17.2 billion deal. A deal that was foiled when Walgreens walked away 2 years later, thanks to resistance from the FTC. Again, the government had your interest at heart. There are only 3 national drugstore chains. Letting 2 of them merge is pretty much the textbook definition of anti-competitive behavior. Come on. But then 6 years later, a hobbled Rite Aid filed for bankruptcy. Rite Aid's still in business, but it's a shell of its former self. Over the summer, they announced they're closing 38% of their stores. In the end, I can't fault the government in either case. If it had allowed these deals to go through, I think we'd be facing higher airline and drugstore prices. But only there isn't much that can be done to save a failing business other than letting it get acquired. Fortunately, Amazon, Walmart, and Costco are all competitors when it comes to much of what the drugstores offer. Unfortunately, there are no Amazon, Costco, or Walmart airlines. So let me salute the government for trying to protect us, but also accept that the capital markets just won't play ball with an aggressive FTC or justice. Whether Spirit gets bought by JetBlue or files for bankruptcy, we're down a competitor either way. In the end, there may have been a lesser of 2 evils here, but frankly, I can't figure out which is which. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.